Hi. Let's learn about the Laffer curve. The Laffer curve is a theory by supply-side economist Arthur Laffer that visually shows the relationship between tax rates and the amount of tax revenue collected by governments. It was created in 1974 and is used to illustrate the argument that cutting tax rates can result in increased total tax revenue. The Laffer curve is a bell curve analysis developed by economist Arthur Laffer. It suggests that taxes could be too low or too high to produce maximum revenue. Tax cuts have two effects on the federal budget: arithmetic and economic. The arithmetic effect is immediate, and every dollar in tax cuts translates directly to one less dollar in government revenue, as well as decreases the stimulative effect of government spending by exactly $1. The economic effect is longer-term and has a multiplier effect. As a tax cut increases income for taxpayers, they will spend it. The increase in demand creates more business activity, spurring an increase in production and employment. On the Laffer curve, tax revenue reaches an optimum point, represented by T star. To the left of T asterisk, increasing rates raise more revenue than is lost to offsetting worker and investor behavior. If the current tax rate is to the right of T asterisk, lowering the tax rate will stimulate economic growth and increase government revenue. Tax revenue does not always increase whenever the tax rate increases. The curve's theory is that the most efficient and ideal tax rate is somewhere between 0% and 100%. Arthur Laffer presented his ideas in 1974, and they influenced President Ronald Reagan's economic policy. During Reagan's time in office, annual federal government current tax receipts doubled. Republicans and Democrats use the Laffer curve to argue their tax policies. Republicans tend to lean towards lower corporate and high-earner taxes, while Democrats tend to lean towards redistributing wealth from high earners to low earners. Critics argue that the Laffer curve is too simplistic. The T asterisk or ideal tax rate changes, tax cuts are required for the rich, and assumptions of individuals and businesses. Actual numbers are missing from the curve, so the actual suggested tax rates and the percentage increase in revenue generated are missing, leaving policymakers to guess which rates work and support Laffer's theory. The Laffer curve displays the relationship between tax rates and tax revenue collected by governments and is often used to illustrate the argument that cutting tax rates can result in increased total tax revenue. However, it assumes both a single tax rate and the behavior of businesses and individuals. Here are three key takeaways. 1. The Laffer curve shows the relationship between tax rates and total tax revenue. 2. The Laffer curve states that total tax revenue is most likely not maximized when tax rates are at 100%, as this disincentives workers from earning wages. 3. The Laffer curve was used as a basis for tax cuts in the 1980s during the Reagan administration. Hope this would help. Thanks for watching.